All right, I know it's been a long time since I've put out a video, and I wanted to take some time today to talk through why I'm putting over $100,000 a year into life insurance. More specifically, right now, it's about $130,000 a year that I'm putting into life insurance. And I know Dave Ramsey would tell me I'm crazy, and he's got all kinds of videos out there saying stuff about that. There's other people who talk about that. But most of the time, when they're talking about this, they don't actually understand how permanent life insurance works. And most of the time, they're also talking about poorly designed life insurance policies. So you really have to do a lot of things right in order to make this work. And that's why when I discovered this, I was like, how fast can I put money into this? And I need to get into this business. So I started this as a business. I actually got my wife licensed as an insurance agent. And if you think this video is informative and you want to work with me, that's cool. I'll leave a link in the video description to book some time with us to work through and discuss how this works and how this can help you as well. And, possibly get you some illustrations. But, if not, and if you already have a life insurance agent that you like working with, we can get you an illustration and they could use that to put a policy in force on you. We want to help people achieve financial independence, financial freedom. So, that's a goal in general. We don't necessarily, we'd love to earn your business, but that's not, all of what this is about. I think that people really need to know about this stuff, especially, with the times that we're in when my aspects of my brokerage account and my 401k and my Roth accounts, I still do those things, but those things have been hit. They've been hit pretty hard this year. And using these permanent life insurance products is a hedge against those things. It can be a hedge against inflation. And also, you can use these things to build wealth elsewhere, because one of the main benefits of this, people talk about it, infinite banking, bank on yourself, cash flow banking. There's a lot of different names for this concept of using insurance to build wealth. Personally, this becomes my line of credit for real estate investment or other things. If I want to do put cash into this, but then take loans against it and put it into options trading account. I can do options trading if I want to take risky investments. What doing this does is it enables me to have, be able to decide that, hey, I'm going to take risk and, seeking much higher returns. I think, so with Index Universal Life, I think a reasonable expectation for your returns over the long term, I'm talking like, 40, 50, 60 years, you can reasonably expect around an 8 to 10% return. I think it might be a little bit higher than that personally, but I think if you come into this thinking that you're going to be getting around 8 to 10% returns in your account, then I think that's a realistic assumption, and I think you're going to be happy with this stuff. So right now, again, we're going to talk about Index Universal Life. Specifically, this carrier is Allianz. That's where I have an Index Universal Life policy. I might be opening a policy with another carrier soon enough, but this is the current Index Universal Life policy that I have. And it's a great carrier for using this strategy for a number of reasons that we're going to get into. So with that said, let's go ahead and jump into it. And right here, this is a blended index that isn't one of the index strategies that you can do in this. So this is not the one that I recommend, and we'll get into reasons why. But there's a number of different indexing strategies that you can do, and index funds that you can sort of index against. And so, this is one that uses some of the more commonly known index funds, and they're not necessarily volatility controlled. In the aggregate, when you combine all these, there's some volatility control in there, but so they can't give you uncapped returns because there is some volatility in all of those index funds, and call options are more expensive. So we're going to get into why that call options are important on this. But this is what gets introduced with these open market funds is this concept of a cap. So you have access to this 8.75%. If the index does 20%, then you get 8.25%. For this particular indexing strategy, you also get a 40% bonus on that. So that's how this gets you. It introduced this 8.25% cap, and then 40% on top of that gets you this 10.5% return. So that the strategies that I like to use for this carrier don't have a cap, and I like to use those uncapped options that are in these volatility control indexes. So that's why I don't prefer these, and we're going to get more into the discussion of that here in a moment. But let's go ahead and move down to it. So the Bloomberg U.S. Dynamic Balance 2 ER Index, that is one of the index strategies that I like to use because it is uncapped. It's a volatility controlled index. And so why does that matter? Well, so the way that the insurance company, in this case Allianz, gets you the returns that we can see on this page is they don't actually invest your funds into the index fund. So let's just say you had $100,000 inside of your insurance policy in one of these index strategies. What they're doing is they're taking that $100,000 and they're buying safe investments, corporate bonds, different types of bonds. They're buying very, very safe investments and getting something like a probably 5 to 7% returns because they got to make some money on those as well, and they offer you somewhere around 4 to 5%, at least in current state. My policy, because it was put in force earlier this year, it's at 4.3%. Now the fixed account is doing 4.7%. So that's the return that they give you if you want to put it in the fixed account for the year. You might get 4 to 5%. So let's just call it $4,500 is what that return would be if you had $100,000 in this. So if you choose to do one of these index strategies, they're going to take that $4,500, not the $100,000. They're going to take that $4,500 and they're going to buy call options against the index that you are choosing. So in the Bloomberg, they'll buy call options. And since this is a volatility controlled index, the call options are cheaper for that volatility control index. They because since there's less volatility, volatility is what increases the cost of call options. And so that's what they're doing. They're buying these options, and that's how they get you these higher returns. And so what happens here as a product of that, because we're using these uncapped volatility control indexes, they give you this participation rate. So this participation rate is a big factor. So if the index does 10% and you have 165% participation rate, that means that you get 16.5% as your return. And on top of that, we get this 40% bonus. And so in a year that the index did 14.73%, that means that you actually get a 33% return because it actually subtracts out this 1% annual asset charge as well. So what that 1% annual asset charge does in this case is it says, okay, rather than that 4 or 5% return that we would normally give you, so that $4,500 of call option buying, well, instead let's take an extra 1% and put it into that. So the insurance company is charging that 1%, and they're going to buy an extra 1% of call options. So it'll take that $4,500 and put it into change it to $5,500 worth of options they're going to buy throughout the year, and that's how they're going to get you these higher returns. So that's a 33% year. That's a monster year. You're not going to expect to get those all the time. You will have some monster years, but if the index goes negative, then you're going to have a negative 1% return in those years. So that's how all of this works. And I mean, what that means for you is that over the long term, you're going to be able to expect somewhere around 8 to 10% returns, throughout the life of your policy. And I think that's fantastic. When you consider for the fact that you're not going to have 0 years, if you're using this as a sort of line of credit to do investments. So if we were to compare this to, let's say, I have a brokerage account. I could have the ability to have asset-based lending. But usually in a brokerage account, if you have asset-based lending, you have run the risk of having, a margin call. So they need to maintain a margin between your assets value and the amount they loan to you, because those things are directly invested in the market and they could go to zero effectively. That's not going to happen here. So that's why these things are very, very powerful and much more advantageous than as a wealth foundation product, because you're protected from a negative 30% year. People who have money in the market right now, some of my accounts might have gone down by around 20 or 30%. And so when you're not exposed to that kind of volatility, then it's a very powerful thing, and you're protecting your compound interest. So that's the thing. If you have funds in the market, compound interest gains can also be compound interest losses. So yeah, and you could employ some of these same strategies on your own. So if you wanted to just put your money into corporate bonds and have yields around 5 to 7%, and take that money from those corporate bonds and invest that into call options, buy call options, you could do all of that. It's work that you could do, but then you don't have death benefit. So because the insurance companies are doing this at such a gigantic scale, they are able to offer a death benefit on top of that. So by having your funds in this, you can, if you pass away for whatever reason, your beneficiaries will have a significant gain on your funds. So all of that is why this is definitely it's something that people should be doing if they have the means to do it. So now I want to talk about why these 4 different index strategies. I like these 2 the most, and I like this one the absolute most. This select index allocation is the best strategy in my opinion because of what are the markets going to do over time. They're going to go up. They're going to have because of our financial system being a fractional reserve banking, and our money is effectively created through debt. And target inflation is around 2%, the markets will go up. All of those things contribute to why markets will continue to go up over time. So having the higher bonus strategies is going to yield higher. And I actually have a spreadsheet on why this, or when this strategy becomes the best, and it's around 2.5% returns. If you want access to that, drop a comment below, or maybe I'll have a link in the description below. Again, and also we'll have a link if you want to book some time to talk with me and see how we can help you implement some of these strategies. I'd love to earn your business. But what they're doing is, you have this participation rate. They're charging you this 1% asset charge, and so that they're buying more call options, and it's going to be the biggest return in the long term. So the markets go up, and you can see when you compare all of these positive years, anything that's basically over 2.5%, you're going to do better than that. So even this, so here's 2.86%. So in 2007, this was 5.6, 5.42, 5.19, 5.42. So this wins out if the market is doing better than 2.5% or so. So that's why it's the strategy that I'm using. I'm most heavily in this strategy. But I'm also actually splitting between these 2 because of you have this carrier allows for this index lock feature. So what you can do is, before I get into that, the way this works is when you put a policy in force and you get put funds into it, it starts an annual point to point. So, and you allocate those funds to one of these index strategies. Let's just say you put a policy in force in January. So it's going to look at the price of the index in January 2023. And then the price of the index in January 2024, a year from then, and whatever the difference is there, that's the percentage that's going to get applied right here. And then it'll put this participation rate on top of that, and then this bonus on top of that, and that's how your return is calculated. So that's the gist of how these strategies work. And so when you split between these 2 index strategies, well, that gives you 2 opportunities for the funds that are in this index strategy to lock in. So let's just say, it's a monster year. The index does 14.73%. So you're really happy with a 33% return for that year. So you go ahead and lock on this one, but you're not sure whether or not that maybe it's going to go higher. And maybe the index goes higher, and you don't lock your other strategy, and so you're able to get possible higher returns on that one. So that's basically the gist of it, and that's why I'm splitting some of the funds between these 2 strategies. So in low years, this strategy is going to be the weakest in low years. So this in 2008, we see that this was a 0.15 or negative 0.15% return, whereas some of these other ones were still somewhat of a small return. So this strategy is actually the weakest in most cases, but in a negative year, you are guaranteed a 0.9% return. But when you look at the difference between 2017, so you had an extra 1.9% in 2015, but in 2017 you have an extra 10% over top of this strategy. So that's why this is my preferred strategy overall. So, all of these things are important to consider, and it depends on what your situation is. Any of these things can have their circumstances where they make sense. So, that's the Bloomberg. The other index strategy that or index option that I like is this PIMCO Tactical Balanced ER Index. It's another volatility controlled index, and so when you look at this, similar to the Bloomberg, we see strong years and we see a bull run market, bull returns for multiple years in a row after the 2008 crisis, but this one, they control the volatility a little bit differently, so the returns are not exactly the same. So I split evenly between the Bloomberg and the PIMCO, and I think that's a good way to go. So they both have their place. And why I really wanted to put this video out now is because when you look at 2008 to 2014, that's a big bull run for this strategy. It looks even better for the Bloomberg. So if you look at the Bloomberg for this 09 to 2014, we're looking at crediting over 10% for 6 years straight. And that's fantastic. I think that's a fantastic, return. So, this is really, we're probably going to be entering a time where this makes a lot of sense for a lot of people to start this now, because, next year might be a recession, and, maybe next year is weaker, but I think, we don't know. I think personally, I think it's going to be a strong year next year. In these index strategies, and so you should get the money in here as soon as possible and have access to multiple bull run years. That's kind of the way that I'm looking at this. I want to put as much money in as fast as possible, because I think we're going to have a strong next 5 to 6 years. So because we've had a big market correction already. So with all that said, I want to jump over and we're going to look at my own policy and take a look at that. All right, so now getting into my own policy. In this case, I am a male, put this in force as a 35-year-old, and my health rating is preferred plus non-tobacco. So that's the highest top rating that you can get, and it's not like I have no problems. I was in the Army Infantry, and I have VA health rating. So it's not like I'm untouchable. A lot of people can qualify for a good health rating. There's different conditions that might hurt your health rating a little bit, but really this can be an effective strategy for people who can get anything above like a standard health rating. And so in my case, I have $1.1 million of life insurance, and I'm putting in around $70,000 per year into this policy. And what this illustration is going to do is going to assume a 6.19% crediting rate. Like I said, I think we can do better. I think we're going to probably see 8 to 10% over the life of this policy. But illustrating conservatively is good. I think so you can expect higher stuff, or you can hope for better. But I think this is a really, really safe assumption in terms of what you can see over the long term. And here I've got $7.4 million in death benefit at age 70, $39 million at age 100. And cash value at age 70 is 6.3 million here. So that's all the stuff that I have going on with this policy. So let's jump into the values here. So again, none of this is guaranteed, but this is what I think is a reasonable conservative estimate of what we can expect in this policy. So I want to explain some of what's going on here, because there's a lot that I didn't understand when looking at an illustration that didn't make any sense to me. And there's actually some things here that sort of discredit the way that Dave Ramsey says you don't get access to your cash value, you only have your death benefit. Well, in this case, I'm paying for $1.1 million in life insurance. We can see that here, $1.1 million in life insurance. But in year one, end of year one, I have 1.1665, significantly higher than 1.1 million, because that's actually just a product of this accumulation value. So that accumulation value is getting tacked onto that $1.1 million of insurance. So my cash value is added to my death benefit that I'm paying for. That's just one point of how Dave Ramsey doesn't understand these life insurance products, or he just is deceptive. I don't know which it is, but not all life insurance will work like this. There are some that are sort of more in line with what Dave Ramsey complains about. but just depending on what you're trying to do, that may or may not be beneficial to you. And so, one of the concepts there is you can have a death benefit that doesn't increase, and what you're doing is you're reducing your net amount at risk, so the amount of insurance that you're actually paying for, and that will reduce the costs that are inside of that policy. So there are circumstances where that might be advantageous, but in my case, for the amount of money that I'm putting in, I have to basically do this increasing death benefit for this carrier and this product. So again, putting around 70K in for the first few years, and this is actually something I probably would have done differently. I designed this policy, or worked with my wife to design this policy in a way that allowed for me to put in a lot of cash early on, because I wanted to put cash from real estate proceeds and a number of different things into an insurance policy. But what I probably would have done differently if I was opening this policy today is I probably would have increased my death benefit in order to get cash in faster, because this is a little bit of weirdness that you see here. So there's a reason why you see this go from 3 years of this 70K and then dropping in year 4 to 18K, because there's the concept of a MEC limit. So that's what we call it, modified endowment contract. That is, there are rules in place that make insurance, and we teeter getting up close to that limit, and because we want to use these as a cash growth product. But that's how you get the tax advantage status. That's how death benefit passes income tax free to your beneficiaries, is because it's considered insurance. And so by putting this in there, with the amount of insurance that I had, I was limited in how much I can put in. And so in this case, it's actually $56,165. That's like how much I could put in over the long-term life of this policy, but I wanted to front load funding this heavier. In hindsight, I probably would have gone with a little bit more death benefit if I wanted to fund it at this 70,000 or so, and then later on, if I wanted to, I could reduce that death benefit as needed. But if I was to work with you and you're in this circumstance where you want to get cash in faster, then that's something we can talk about and discuss based on your situation. So with all of that, we're looking at here, the other thing to consider is we've got accumulation value and cash value, and you see, these are two different things. So cash value factors in the surrender charges. For the first 12 years, you'll see that the cash value is less than the accumulation value, and in year 13, you'll see that those amounts are actually equal. So when we look at that, we can see those things are equal in year 13 because there are no longer surrender charges. And so the surrender charges are, the insurance company protecting themselves. They've paid the commission to the agent. They've paid for your medical exam and pulling your records, and they've got staff that they got to pay. So there's a lot of reasons for that. This carrier does 12 years of surrender charges, and that's why those things don't line up. When your interest is credited, it's based on your accumulation value. So, if the market does 10% in year 2, as an example, then my account should get credited with around $13,800 for that year. So your earnings are going to be based off your accumulation value. The other place where these things will not align, so your cash value and your accumulation value, is if you used the indexed loan option. And so if you take an index loan, let's say in year 5, I take $100,000 out as an indexed loan, I will pay interest to the insurance company for that $100,000, and this cash value will be reduced to $204,000. But the accumulation value, the amount that is earning interest, is actually going to continue to be here, at that accumulation value. So I'll pay interest on that $100,000. That will reduce my cash value by $100,000, but I will earn interest based on the accumulation value. And that's what really makes this very, very powerful. So you have, and compared to whole life, you have the opportunity for some really, really big arbitrage. And that's sort of the go-between of the interest that you're paying and the interest that you're earning. That's what we're talking about when we say arbitrage. So within an indexed universal life policy, you can have the opportunity to have years where you are paying 5% in interest and earning 10, 12% in your policy on those same funds that are in your policy. So that's what's really powerful about this. And there's not really a comparison of that, other than if you were doing a securities-based lending with your brokerage, But in the case of your brokerage, because you're actually invested in the markets, they will want to keep a margin. Usually it's 30 to 50%. You must have like a really good scenario and a ton of money if they're going to give you like a 50% asset value margin. So if you had $100,000 inside of your brokerage account and you wanted asset-based lending, they might give you, the $30,000 as your line of credit with that. And with that $100,000, you might have a 30% year, so you earn $30,000 in interest, or in crediting in a sense. But your funds that you had a loan for in 30%, you might pay a couple points of interest, so you're earning money on it. So it's similar, but you run the risk of a margin call. So let's say you have $100,000 in the stock market and you lose 30%. Well, now you have $70K in value in that brokerage account, and your loan out for $30,000 is too high. You don't have enough margin, so you'd have to come out of pocket, either pay off the loan or come out of pocket for $9,000 to continue to have that, because your 30% of 70,000 is like 21,000. So, that's another thing to consider. That's why there's not really a parity with all of these things. And so, yeah, so like by year 13, I should have around $1 million in cash value, 2.1 million in death benefit, and it's just going to grow from there. And that's what's really powerful about using an index universal life policy to build wealth. And in turn, I'm using this. If I want to go and buy a property, cash, I can buy property cash and employ the BRRRR strategy. So I have a video on that on this channel, so you can check out my video on the BRRRR real estate investment strategy, where you reuse your capital over and over again to build out your real estate portfolio. So I can buy properties cash and then eventually cash out, refi, and pay off the loan to the insurance company, and have that as a rental property, earning me cash flow, and at the same time I'm earning interest here. So this is how you can really just kind of accelerate your wealth growth by using these types of things. So I want to make sure I cover one of these, the negative points of really any life insurance product for cash value growth. And so what you'll see here in these early years is that we have $70,000 a year or so going into this policy, and it isn't until year 3 that we're pretty close to breaking even based on this illustration of 6.19% returns. We might do better than that, but like even in the illustration and in any life insurance that's out there, you're not going to see a break even for at least a few years, and that's what I call the capitalization period. So you have to capitalize your policy in order for it to get the growth and overcome the expenses that are in the insurance. So in year 4, this shows it's definitely breaking even, because 18,600 something plus 210,000 from the 3 years of this. It's showing a break even in year 4 on the cash value. Again, accumulation value is what your crediting is based off of, but in terms of what you have access to or what you could walk away with in this policy, it takes about 4 years for this policy to break even. So, and that's going to depend on how quickly that is. Will be affected by your health rating and how much money you're putting in with respect to sort of what your MEC limit is, your modified endowment contract limit. So it's going to vary, and also in this case in an IUL, it's going to depend on what the market does. So you could see better. You might see a year or 2 break even if the market has some crazy years. But it's I want to make sure that we cover all of the negatives along with the positives in this, using this strategy. So I want to talk a little bit about over time, people get to retirement age or at some point, and really at any point, we could make changes in the policy and how we're doing the policy to stop paying anything out of pocket if you want to. But personally, I'm funding this for life, basically until I can. Basically, age 100 is when this policy is mature. I want to fund it as long as possible, because at any point that money is just earning money, and so I could even take a loan against my policy and when I'm age 61 to pay this premium if I wanted to. And we just talked about that arbitrage. I'll be earning more than I'm paying in interest. So that's something that you can do as you get to these later years. And so by the time I'm in my 60s, this is based off of that 6.19% crediting. I think, like I said, we'll do better. These numbers might be even much higher. But, looking at this, we've got 3.3 million in cash value. I could basically turn off the insurance, go to the minimum amount of insurance I wanted to, and I could start drawing like a pension. It'd be a pretty good size chunk of money each year if I wanted to take money out of this. And if I'm doing it with policy loans, I actually have it's tax free. So I'm taking loans against my policy, and that's sort of getting subtracted from my death benefit. But my accumulation value will continue to earn. So my balance, my cash value, won't necessarily go down. So I can use that as a sort of pension that is a tax free income stream, and continue to fund lifestyle or whatever, and then it just gets subtracted from my death benefit when I pass away. And it's tax-free because I'm accessing it through policy loans. So long as you're not just withdrawing it. You can also do withdrawals, but in an index universal life policy, it's probably better to do these loans because you have that opportunity for arbitrage. But you can actually withdraw up to your basis. So the amount of money that you've put in, you can withdraw up to that amount tax-free if for whatever reason you wanted to. Again, I'll probably do more in-depth videos as to why it's better to just do the policy loans. But if you need to, you can withdraw, and that's something that is an option as well. So and looking at this in these later years, these numbers are pretty crazy, right? Like there's lots of money in this policy that I can continue to use to buy real estate investment properties and use that cash flow to continue to fund this as well. So again, why I'm looking at funding this for the rest of my life is that I'm using these things to build out cash flowing assets. That's the goal with all of this, is build out cash flow assets to sustain this policy and use this policy to build out cash flow assets. It's the circular cycle. And same thing with my whole life. All of these things are, really how you can accelerate your wealth growth. So I mentioned earlier, having the policy maturity at age 100. So you can see here that at age 100, this is there's still death benefit because we have the cash value and accumulation value here, and this is $1.1 million higher. But by age 101, all of these values match up. So the cash value, the accumulation value, and the death benefit, they're all equal by age 101. So at that point, you're no longer necessarily paying for insurance, and that's what reduces these costs. So you see these total charges. These numbers seem crazy, but when you think about it, if you're paying for $1.1 million of insurance at age 100, a time when you're quite likely going to die, you're paying $537,000 to get $1.1 million in death benefit. It's still worth it. This product doesn't let you pay beyond that, so you can't have insurance, and there's these charges afterward, just to sort of keep the policy in force, managerial stuff, sort of like asset management stuff. So at that point, you're no longer really paying for insurance. You have this insurance policy, and this death benefit will pass income tax free to your beneficiaries, and you still have access to the cash value for policy loans and such. But you're not really. It's no longer really insurance in the sense that it's the cash value is your death benefit, and so that's what we can see here. And that's really something just to keep in mind is that at any point, if we wanted to kind of just say, I don't want to put money into this, we can say, all right, let's reduce the death benefit to the minimum necessary, so even before policy maturity, and we can stop putting in this money. But like I said, if the money's just earning money, then why not put the money in there, in my opinion. So that's another thing to keep in mind. All right, so when we look at these index strategies, so as I said, these are the strategies that I'm using. I think I like the 40% bonus, which is the select strategy, which you have the 1% asset charge. So I'm doing select on both the Bloomberg and the PIMCO with that select strategy. And then there's this bonus strategy, which is that 15% bonus. And so those things are, what we can show with this. And so, we're getting 6% rate in this illustration is what we're showing. But again, I think we're going to do better. 8 to 10%, I think, is realistic. And I'm doing these 4 different strategies because that gives me access to 4 different annual point-to-points where I can lock in an index lock, so that if I'm happy with a 20% return in a year, I can say, all right, I'm going to lock that because I think there's going to be some volatility coming up. I think it's time to lock. So, again, it's time in the market. You don't necessarily have to do that, but I just wanted that option. And I may shift these things over time, so we'll see how that goes. All right, so looking here, we have, the different index strategies and sort of these hypothetical returns. One thing to consider with this page that I didn't fully understand at first is that these returns are not actually factoring in the bonus. So that's why you see that the 15% is exactly the same as the 40%. So it's just, I think, because of the fact that they're not, these guaranteed bonus situations. I mean, you're guaranteed to have the 40%, but it's not like this 0.9% guarantee. This gets paid out even if it's a 0 year. You'll get 0.9% credit. So they can't illustrate those things, but this does factor in the participation rate. And as I said, my policy was put in force when the participation rates were lower. They're now 165%. Mine shows 145. I'll get that 165 at my policy anniversary in February. So, but all that considered, this is realistically, so not factoring in that 40%, over a 15-year period, we're looking at 8% returns on each of these index strategies. And when you factor in a 40% or 15% bonus on top of that, you're really looking at a 10 or so percent, 9 to 10, 12% return over a 15-year period. And these index things don't go that far back. They're relatively new index funds. But now you'll have access to these going forward, and they do a pretty good job of controlling volatility. So I think we are going to see them be strong in this policy over the years. So all of that's considered, and so this guaranteed one, I don't like the strategy. It shows lower, but that's really again because the participation rate's lower. I think the best strategy is the 40% with the 1% asset charge. But I'm mixing it up just to have those extra index lock options. And then one other thing you can see here is that my account has this 4.35 fixed interest account. I think it's now like 4.7. So mine will get adjusted up once my policy anniversary happens in February. So if you were to get a policy, if you wanted to put your stuff into a safe fixed account, you could. Again, I don't recommend it. I think the power here is in these index strategies. So that is an option though as well. So another thing that you surely do not get inside of a brokerage account or whatever is the ability to access up to a death benefit. So going beyond what your cash value is in the event that some kind of life situation happens. And so in this case, if you have a chronic illness, you could access up to your full death benefit. In the event that you needed to cover costs of that chronic illness, and so you don't have to live impoverished when and you're still living. So that's just a really powerful thing as well in this. And then also there is the terminal illness. So with the terminal illness rider, you have access to your death benefit if you are diagnosed with a terminal illness. In this case, up to $1 million. So these are just benefits that you just don't get anywhere else. It's just by virtue of being insurance, you have access to extra value if you need it in the event that you need it. So that's just, again, an advantage here over anything else. So just another thing, companies get rated by Standard & Poor, AM Best, Moody's. Like these are rating systems. This just shows that Allianz is a very strong company financially. So when you are considering getting a policy like this, you're putting it into a strong company that is going to stick around for the long term. This is how the policy works. You have your accumulation value, fixed and index options. You've got loans and withdrawals for accessing the funds. You've got death benefit, and you got your premium. So I've talked through a lot of these things, and here's just a nice little diagram that's walking through that stuff. So, this is kind of how a lot of that works. And we're going to talk here in a moment about the policy loans. So that is a really big piece of why this is a great strategy. And here's a diagram of the how the index crediting works, and these concepts of these annual point to points. So that's how this index crediting works inside of your policy. And we've talked through a lot of this. This is just an example so you can see it visually. All right, and this is what I was mentioning with the ability to have an index lock feature. So you can lock if you think that the market might take a downturn. You can lock and ensure that you're going to have gains. Again, it's sort of timing the market. I may or may not even end up using my lock features, but I am doing 4 different strategies to have access to 4 different lock timeframes. And here's a chart of the bonus options. I've talked through a lot of this again as well. But if you're curious about how they describe it, here's how these index strategies work. So I again recommend this select and bonus option. I think those are the best strategies. All right. So one of the most important factors with these life insurance, index universal life is how you access the funds that you've put into it. And so, as I mentioned, when we were looking at the values inside of the policy, you have access to about 90% or so of your cash value, and so you can take these loans, and you have in Allianz you have two loan structures: the fixed and the indexed loan. 99% of scenarios, I think that index loan is the way to go. There are circumstances where I might end up taking a fixed loan, but there's a good reason not to, and that's conceptually in years 1 through 10 you get a 2.9% rate. That's what you pay to the insurance company to access those funds, and they credit your account with 2%. So your effective rate is 0.91%. But if you were to compare that to if you just kept it in the fixed account, you're also not getting 4.3 or 4.7% credited there. So those funds are no longer earning that amount. They're earning 2%. So you're reducing what could be your return of 4% or even higher if you're talking about comparing it to index loans. So you're reducing your return, and that's a you're not going to have arbitrage. You're sort of losing money as a product of using this. It's still not a bad option when you compare it to other things out there, but I don't think it's the best thing within this policy. And so after, in years 11 plus, you get 1.96, still getting credited this 2% year, 2% for that same year for the funds that you have a loan against using this option. So, that's good. It's a wash loan. You're effectively taking zero interest loans. And this is, again, why I don't recommend pulling the funds out, because you can, in years 11 plus, you could just use this option. It's sort of the equivalent of pulling those funds out. But you still have access to saying, all right, well, actually, I want to pay off that loan, or I want to reallocate it to the indexed loan. So the indexed loan, this is a big factor here. So the indexed loan is what's the real power inside of an IUL, and specifically in Allianz. So you're going to pay, this is a guaranteed rate, 5% is your interest rate that you will pay to the insurance company, but you will continue to be credited on the funds that you have a loan against. So if you have a $100,000 loan against your cash value, you're going to be credited based on that $100,000 loan. Let's just say the index and all the crediting with the bonus and everything, you're getting a 10% credit. So you'll have made $10,000 on those funds while you're paying 5% in interest. And that's where the real power is. And especially as you get to these higher cash values, you get a ton of ability to have massive arbitrage. So I hope this video has been informative for you. I really appreciate you taking the time. I know this is a super long video, and if you are interested in learning more about this, check the video description down below to book a meeting with me. If you think I'm crazy, if me putting in $100,000 a year into an insurance policy is crazy to you, drop a comment. Let me know why. What doesn't add up here? I would love to hear your opinion on this. I think this is one of the best strategies you can do to build long-term wealth. But people might have valid arguments against it. I've done a lot of research and analysis, and there's a reason why I'm putting my money where my mouth is. I'm putting over $100,000 a year into life insurance. I will be putting out a follow-up video regarding my whole life insurance policy that I have. I think there's a place for whole life for sure in most people's portfolio, but it's structurally a little bit different. So I do both of these things, and I'm putting in similar amounts of money into each of these. So again, if you want to book a meeting with us, check the video description. I also I'm going to chop up this video into smaller pieces in order to really show so that people can watch smaller bits as they need to.